If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? Welcome back to the Courtside Financial Podcast, the podcast where we talk about the biggest stories in business and technology. I tend to focus on China's EV market. So that's what we're going to talk about today. Some things happening in China's EV market that are super relevant and could reshape the entire industry landscape. So this is going to be a super interesting, super insightful video. We've got a lot to unpack today, so grab your coffee. But before we get started, if you're new to the channel, you already know what to do. Please hit the subscribe button. We're trying to get to 10,000 subscribers this year. You guys have been great. If you're watching this video, please make sure you hit the subscribe button. If you're new to the channel, make sure you hit the like button. Click the notification bell icon. Leave a comment down below. All your engagement really does go a long way in helping out the channel to grow, helping it to reach a broader audience and share this good information that we research, being able to help and serve more people. So without further ado, let's get into today's action-packed episode. You know, I've been following the Chinese EV market pretty closely, particularly as a NIO bull, but what we're seeing in the broader realm is what I'll call the great 2024 to 2025 shakeout. And it's absolutely fascinating, but at the same time terrifying. Let's start with the story that really brings this home. There's this guy named Chen Zhidong, name changed for privacy, but he bought a Jiyue 07. He bought this car just a week before the company went bankrupt. Think about that for a second. He was making a smart choice. He was buying a car from a company with major manufacturing support. And just like that, boom, his car became what the industry is referring to as an unfinished car. Now he's afraid to drive it, except for registration purposes. This isn't just one isolated case, it's a pattern. Let me break down the carnage that we've witnessed over the past year. HiPhi Auto, gone in February 2024. Hycan, complete collapse. Jiyue just announced their refund process on January 17th. Nezha Auto, struggling with wage arrears, layoffs, and even their website has gone down. Now let's talk about the broader market, because this is where it gets really interesting, and we'll talk about what it means for investors. First, let's dive into the economics of survival in the EV space. Industry experts say that you need about 500,000 vehicles to reach economies of scale. That's roughly 40K vehicles per month. Now here's where it gets interesting. We're seeing that numerous car companies can't even hit 5,000 vehicles monthly. Let me give you specific examples. You've got Polestar, Jack Motors, Blue Star, Skyworth, Jack Yizhen. These companies are all struggling to hit that critical threshold, but it's not just about the numbers, it's about the ripple effect. Here's where things get really fascinating. We're seeing a complete collapse of consumer trust in these smaller, newer car companies. Let me share another story that illustrates this perfectly. Liu Kue from Tianjin, another name change for anonymity reasons. My camera battery just died, but he recently did something that captures the market psychology right now. He rented a Polestar 4 on the same day that he placed an order for a Tesla Model Y. Why? Because he didn't trust Polestar's long-term viability, even though he loved the car. Think about what that means for market dynamics. Now let's talk about why NIO is uniquely positioned in all of this chaos. It's not just about car sales. They've added a new car company, ArcFox. Yes, ArcFox is the 16th brand to join their infrastructure charging alliance. Let's break down NIO's infrastructure numbers. 2,623 supercharging stations, 12,157 charging piles, 1,683 destination charging stations, 13,115 destination charging piles, 3,035 battery swapping stations, and 952 highway located swapping stations. This isn't just impressive, it's a moat. While other companies are struggling to maintain basic operations, NIO's building infrastructure network that companies are beginning to rely on. Now let's get into some real exciting news for NIO investors. The CICC is reporting that NIO is likely to be included in the Hang Seng Index. So let me break down why this is huge. Long story short, there's a massive pool, tens of billions of dollars in investment funds that could start flowing into NIO. So here's where NIO's strategy gets brilliant and why I think that they could be one of the biggest winners throughout this entire EV shakeout that I mentioned earlier in the video. While everyone's focused on the luxury segment, NIO's been preparing to intensify their two sub-brands. Obviously, Envo's already on the market, Firefly to begin deliveries in the first half of the year. It's just genius level timing, and here's why. Number one, there's a trust transfer. When consumers are worried about smaller brands, NIO's reputation is going to transfer over to these sub-brands. There's also infrastructure sharing. Envo can obviously leverage NIO's existing infrastructure, and NIO already has the technology to build good swap stations for the Firefly brand as well. And then number three is that there's a market gap. As smaller players fail, there's a growing gap in the market for more affordable, more reliable EVs. Like I said, this also kind of ties in with number one, but NIO can fill that gap with their sub-brand. So let me share something that I've noticed over the years. When you see this kind of consolidation in the industry, it's usually what you could refer to as a flight to quality, a phase where consumers become risk adverse. We're seeing this play out in real time here. Consider the consumer behaviors we're observing. People putting warning signs on their cars about repairs, owners forming support groups to share spare parts, and consumers willing to pay premium prices, or a premium, I should say, for established brands. This is creating what we call a trust premium, and obviously for the three reasons I mentioned a little bit ago, NIO's well positioned to capture and capitalize on it. Now let's zoom out and think about what this means for the global EV market. The Chinese market has often been a good indicator of EV trends, and this consolidation could be a good preview of what's coming for us globally. For US investors like myself in NIO on the NYSE, this can mean that there's a stronger competitive position in China for NIO, better economies of scale for global expansion, increased institutional investor interest, and potential for higher margins as the competition decreases. Despite NIO stock taking a 53% hit on the Hong Kong Stock Exchange in 2024, I remain bullish on NIO, and here's why. Market consolidation favors established players. Infrastructure advantage is widening. NIO has a smart sub-brand strategy. Potential index inclusion with what we talked about the Hong Kong Stock Exchange, and growing consumer trust premium. The Chinese EV market is going through something that I personally knew, and I think most of us knew would happen from the beginning when we saw so many different car companies, everyone trying to get a piece of the pie in the beginning of all this. I think in 2019 we were talking about this, but what I call a necessary purge or consolidation. It's painful, it's messy, but it's creating opportunities for survivors. NIO, with its established brand, expanding charging network, and strategic move into sub-brands, isn't just positioned to survive. In my opinion, they're positioned to thrive. Anyways, before you go, I'd love to hear your thoughts on this market consolidation. Are you seeing similar patterns in other markets? Are you thinking about it the same way that I'm thinking about it? And how do you think this will affect global players in the global EV industry? Leave a comment down below and we'll catch you in the next episode. Thanks for watching.